the president stressed this tax strategy in his State of the Union address. He proposed that every multinational company should have to pay a minimum tax no matter where they operate in the world. In today's Reaganomics, does a minimum corporate tax create an incentive for companies to bring jobs home, or does it penalize them for operating abroad? Joining me now to debate it, Scott Hodge, president of the Tax Foundation, and Bob McIntyre, president of the Citizens for Tax Justice. Welcome to both of you. Scott, I'll begin with you. Seems to me that the minimum tax isn't really going to bring a lot of jobs back, but it might make our companies less able to compete in the global marketplace. Your take on this?
Well, that's exactly right. And what the president is proposing is essentially a Buffett rule on U.S. companies trying to do business in the global environment. The immediate effect of it would be to really undermine the competitiveness of U.S. companies working abroad, and really undermine the competitiveness of the U.S. economy and our workers. And as a result, it would have a counterproductive effect on actually killing jobs in the United States, and as a result, reducing our overall competitiveness globally.
Bob, what's wrong, from your opinion, or from your perspective, with what Scott's saying?
Well, what this tax would do, that the president has proposed, is get a little bit of money out of the multinational corporations on the profits that they've shifted offshore, mostly with artificial devices, but sometimes with real activities. And he's going to use the money that this tax raises to give more incentives to do things in the United States. So it's not going to raise corporate taxes, it's just going to make it more attractive to have jobs and investment in America. That seems like a reasonable thing to do, at least on the face of it.
But on the face of it, it may seem reasonable, but you know, you always have to worry about the unintended consequences of economic policy. Scott, walk us through some of these unintended consequences.
Well, the first unintended consequence would be to undermine the competitiveness of companies like Caterpillar, which you just announced their earnings, in order to subsidize or benefit other companies that are more preferenced here in the United States. That's really industrial policy. It's wrong tax policy to essentially tax Paul in order to subsidize Peter. But what we're talking about is...
Well, wait a minute, Scott, that's what we do with taxes. I mean, we have to,
well,
when we tax some people to help others, that's what we do.
Okay, hang on, Scott. I want to get Bob in there. Hang on, let's just get Bob in real quick, and we'll go back to you. Bob, go ahead.
I mean, look, when we tax somebody so that we can pay for college educations for students, that's taxing Peter to pay Paul, but it makes sense. And if we get these multinationals that are avoiding their tax responsibilities to pay some taxes, maybe we can do something to educate the workers and build the infrastructure and do things that will make us more competitive.
Hang on one second. Scott, let me go to you. Doesn't this sound a little bit like redistribution of wealth?
Well, of course it is, and that's what this administration is all about. But the biggest disincentive to creating jobs in the United States is the fact that we have the second highest corporate tax rate in the industrialized world. Only Japan has a higher corporate tax rate than we do, and in 3 months they're going to reduce their corporate tax rate to make us the #1 highest corporate tax rate in the world. Plus, we have a worldwide corporate tax system, which no other industrial or few other industrialized countries have, including our major competitors such as Japan and Great Britain and Canada, all have what's known as a territorial system to make themselves more competitive. We're in the dark ages here when it comes to corporate taxes, and it's making us less competitive in a global market.
And Bob, you don't want to be less competitive.
Oh, no, we don't. And when it comes to corporate taxes, we may have a relatively high rate, a little higher than the others, but we have the lowest effective rate because of all the loopholes we have.
No, that's not true, Bob.
The multinational corporations in particular. In fact, we did a study last fall that found that of the 280 big Fortune 500 companies we looked at, that a quarter of them paid less than 10% in taxes, 30 of them paid absolutely nothing. We've got a corporate mess on our hands in the tax code. Scott wants to fix it by lowering corporate taxes. I want to make these big guys pay their fair share so that we can protect government programs.
Well, what about a compromise? Hey, guys, what about a compromise? What if we said no more loopholes, but we're going to hold you to a lower tax rate, but again, no more loopholes? Would either of you buy into that? Scott, your answer first.
Well, the basic problem with that is that you can only eliminate so many loopholes and lower the corporate tax rate so much, and so it really doesn't make us that much more competitive. If you eliminate all the corporate loopholes in the tax code, it would only allow us to lower the corporate tax rate to about 28% at the federal level, and we really need to be down about 20% to make us at the global average.
Okay, so
and
you put us
really
at
20%.
Let's just walk this through. We're 20% and no more loopholes. Would you buy into something like that, Bob, or absolutely not?
Well, absolutely not, because it would cost too much money, and then the rest of us would have to pay for it. But we could cut the corporate rate a little bit by closing loopholes, and we'd be more competitive, in large part, if we raise some money, because we can fix those crumbling bridges and get our college graduation rate back up to where it ought to be, and do a lot of other things
something with that money.
Cut the deficit.
Hey, Scott, we just have a little bit of time left. I just want to talk about the reality of all this, whether or not we'd actually see something like a minimum tax on global corporations, no matter where they operate in the world, really happen. I mean, the administration would have to get this through Congress at the end of the day. Could they?
No, I think the chances are roughly zero, especially given the makeup of the House with the chairman of the Ways and Means Committee, Dave Camp, would never allow that to happen.
And Bob?
Well, the chairman of the Ways and Means Committee has a paper out suggesting doing exactly that. So I think it may be something we'll be seeing in the future, probably not this year.
Well, it may all depend on how this election plays out and who's in the White House and who's controlling Congress. Thank you so much to both you guys. Scott Hodge, a great debate from the Tax Foundation. Bob McIntyre, Citizens for Tax Justice.